Hi, good day. This is a brief introduction into the taxing of high net worth individuals, scheduled for the 14th of May at 3 o'clock. When preparing for this webinar, it was a case of saying that the apocalypse is coming and are we ready for our clients? At the end of the day, I think tax compliance for high net worth individuals has changed substantially, and it's no longer a case of what was declared and what is in the tax returns, but SARS are asking us to show what is the position, what is the information behind it, and they are putting the jigsaw puzzle and the pieces together or joining the dots. So from that point of view, it's important to ensure that it's not just so much as declaring what is in the tax return, is declaring what's not in the tax return. I think the common reporting standards and the cross-sharing of cross-border information is real, it's alive and it's well and it's happening. And to that extent, we need to ensure that the approach that we adopt with looking after, I don't want to say it's all clients, but especially clients within that high net worth bracket. SARS defines a high net worth client at 75 million plus, but it's ensuring that we are battle ready. So from a SARS perspective, there haven't been many changes with regards to the legislation. Changes have happened rather in the form of the collection of taxes, the referencing of transactions, and the scrutinizing of structures. So it's not so much a case of compliance anymore, it's a case of defensible governance. And what do I mean by defensible governance? We need to build a tax file, almost an audit file, that's not just a tax compliance file. Work on the basis of every tax audit that you might have will lead to a high escalation. So therefore, prepare what you're doing now for future reference on the basis of, to give you an example, if you're preparing tax returns that have got transactional structures that have been put in place now, do your documentation in the form of file notes, practice notes, decisions, put in the legal history and the documentation attached to it. From a mismatching of information and disclosures between what SARS gathers from a data perspective and what's reflected in the tax return automatically triggers the case selection. Although corporate tax, trust, income tax, estates, the VDP unit, the trust-to-trust application unit, all seem to have separate units that are actually talking to each other. To give you a recent case now at the moment where we're busy with the client's immigration as well as a trust-to-trust application, SARS was fully aware of information regarding the unlisted company of which the client was a director and a minority shareholder on, and in fact questioned information relating to certain transactions that obviously affected our client in his capacity as a shareholder, and want to know how that share information and the distribution and the changes as a result of a share transaction affected an immigration and trust-to-trust application. So the story of you dealing with each section independently is not the case. We certainly have sharing of information both on a cross-border basis and within SARS. Scrutinizing trust transactions. These are the primary focus from a SARS point of view at the moment. So if you've got clients in as either founder, beneficiaries and or funders of trusts, ensure that the information that's reflected in the trust financials, the trust documentation and tax return, and then in the individual's tax return is correct and matches. A big one is in connection with the provisional tax and cash flows. At the moment, we're finding that, I'm sure if you've had a look and received queries for your second provisional return that was due at the end of last February, or this February just passed rather, the number of inquiries we had on the basis of providing the calculations, supporting that information. So treat each SARS engagement as if it was litigation ready. So even doing the provisional tax return, if there's been decisions made as to what income to exclude or not reflect in provisional returns, make sure that the reasons are readily available, whether it's an audit now or whether it will be an audit in a couple of years' time. Integrate estate duty and capital gains tax planning, ensure consistency across all filings. I think, as I said, the landscape has changed in that we're no longer just dealing with legislative changes. There's massive administration, pressure, and collection of funds. From an income tax point of view, we'll very briefly have a look at the donations tax and interspousal, as well as retirement funding for retirement funding for estate planning. And then in connection with the structures, the three areas that we would consider and have a look at is the 7C. That seems to again be a focus area, certainly with the dealings that I've had with regards to high net worth client queries. It's been around the 7C with regards to the disclosures, the calculations, and the calculations are not so much just tell us how you got to the figure. They actually want to see the amortization schedule, whether it's done then on a daily or a monthly basis. So it's having a look at the 7Cs, having a look at debit loan accounts. And then I do want to bring into this webinar the withdrawal of practice note number 39 and the introduction of section 11G. Although it won't be for the tax returns due by the end, the February 26 returns due for the end of 27, it's essentially only going to start from the 1st of March 20, for the 27 filing period. It's important to understand what those the implications will have on our clients in the form of the structures and in the form of the feasibility of those structures. And if there's any planning that's being done now at the moment, ensure that the planning is sound and robust. The decisions made in executing any of that planning can stand up to scrutiny, and again, just the documentation. So the content of the webinar is not so much on what has changed from a Tax Act point of view. I know that's dealt with via a number of, I want to say the technical and the far brighter and cleverer people from a technical side. I want to focus and have a look at how not to get that lifestyle audit for your client, and just preparing files and information on the basis of making sure that are we ready for whatever SARS throws at us, whether it's now in connection with the audit come the end of the year with requests for information, or whether it's in the period of 3 or 5 years' time, be it an immigration, be it a death, be it a trust-to-trust application. Based on what we've seen recently with dealing with this client's immigration and trust-to-trust application, SARS have essentially gone back to transactions that were executed some 12 years ago and asked to unpack in the form of that was the source of funds, and again, just looking at the integrity of the structures that were put in place at that time. So the playing fields have definitely changed. It's not so much completing what you know, it's interrogating your information and ask the question, what aren't we seeing on that piece of paper when we submit the tax return, and making sure that we can answer those questions when they come. So look forward to seeing you then on the 14th of May at 3 o'clock. It's a 2-hour webinar, and hopefully we can put as a team, put a pack together that will enable you to manage both your clients' risks and the time that you take as a tax practitioner in compiling those audit responses, especially from a chargeability point of view, if it's a case of trying to get your file notes and practice management in place in order to be able to respond. Rather do it now than down the line. Put in, as I say, if we've got to be battle ready, treat each engagement as if there was litigation. So I look forward to having a conversation with you and working through it on the 14th of May at 3 o'clock. Thank you.